Welcome to This Week in Money. I'm Jim Goddard. Today, market historian and chief investment strategist for chartsandmarkets.com, Bob Hoye, gives us a major market comment on the past week, including the Dow's major meltdown on Friday. Bob also talks about China closing its stock market due to the coronavirus. He answers some listener questions about gold and silver, and also wades in on some recent headlines about negative interest rates. RealEstateTiming.com publisher Robert Campbell checks in from San Diego to give us an overall picture of the U.S. real estate market. He also has advice on investment and health. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh, Cypress Development's Don Mosher, and Aben Resources CEO Jim Pettit. We'll talk to Bob Hoye right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Bob.
Hi, Jim. It's good to be with you and with our listeners.
Bob, first of all, we'll take a look at what happened on the major markets over the past week. The Dow suffering a major meltdown on Friday.
Yeah, it was weak into right towards the close on the different stock indexes. The industrial commodities such as base metals were weak, and crude oil. So this is important that when these things weaken, they're telling a story. But in work I did yesterday, some of these base metal prices like copper are getting down to a level where they might find some support. But the thing is that a lot of the urgency in the selling has been due to this virus threat that's sweeping China. And they, of course, closed their exchanges, which they should never do. I mean, exchanges exist to allow people to trade and clear their positions, but they're saying they'll get them going back on their Monday, so we'll watch and see what happens there. But the thing about the market being hit is that the stock market itself, using our technical work, were extremely overbought. You had, in our terms, upside exhaustion readings, which is a sophisticated momentum-related measure. And then the other one we use, which is a pattern, which is a sequential sell. And then plus you had exceptionally high valuations. So the market was eligible for a hit. Now the other one, which is I love to talk about, Jim, is that in early October we said that the next leg up could be strong enough, and if it remains strong enough into the turn of the year, it may set an important high. And then we used examples such as gold and silver in January 1980, the big Tokyo speculation bubble with the Nikkei to the last trading day of 1989. So there has been a long probability of really good speculative moves coming in and concluding at the turn of the year, which we have. So the only thing I could see is that the stock, like the base metals and the stock indexes, they had turned down before the bad news came out about the virus, and that then has made selling a little more urgent. But then you look back on it and you say you can never alter history, but if there wasn't this viral threat, the markets would have sold off anyways. And then the news people would have come up with a different story on that. But let's put it this way: the problem, this possible epidemic, did add further urgency to selling, and perhaps it's getting, some of these series we watch are getting close to a support level where you could have a relief bounce. But in looking at the degree of upside exhaustions we had and our sequential sell patterns, this could be an intermediate sell-off which could run for many months. On the other hand, if you look at how long the bull market's been running, which is since the lows of February 2009, this is an extremely long run. And one should begin to look around for, say, maybe, hey, this is a cyclical peak, and you could, there is some risk that you could have more of a cyclical bear market, but it'll take a little more work on our part for that, and people who are interested can check into our website and look for some of our research. But it's been a fascinating week in the markets. On the other side, you had the counter trade with the long Treasury bonds in the States and long Government of Canada bonds, the high-grade bonds having a nice rally, whereas the lower grade bonds, they were hit. They usually go down with industrial commodity prices. So it's been an interesting week.
Bob, how has gold been reacting so far?
Well, and recently they just gold and silver had a very good summer, and they took a rally here earlier in the week, and it's been up on the week, so it's been the counter trade with the bonds, and that makes sense too, because you had some setbacks in September when then the counter trade with the August and September was the long Treasury, long Government of Canada bonds, as well as gold and silver. So you've got this counter trade going on, which may be getting a little overdone. And as I mentioned, the liquidity pressures over in industrial commodities and the general stock indexes, they may be getting a little overdone as well. So it's going to be interesting to see come next week with the Chinese markets reopening, really what happens there. I wouldn't want to be a trader on it because it could get whipsawed all over the place. But if you're watching at it from a distance, it will be interesting. On the other hand, we'll be watching overall just to see how important the recent high has been. And as I mentioned, we had all kinds of technical excesses with it, and then we've had the right kind of correction with it, and I would say just made a little more than otherwise might have happened because you have markets in a fearful state. And so bad so that in China, the authorities took the steps of stopping trading, and this one should never do. So it's going to be an interesting week next week, Jim.
And we'll have more comments from Bob about the Chinese closure of the stock markets. Plus, Bob will answer listener questions from our two longtime listeners, Kate and Cecil, right after this.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're still chatting with Bob Hoye. Bob, China is closing its stock markets until at least Monday because of the coronavirus. Is there more behind this than just fears of spreading this disease?
Yeah, well, I think socialist, bureaucratic, communist country, and with those skills, nothing can go wrong. And then now you have this virus, and there hasn't been something like this since 2003, I think it was, when they had the SARS virus. I believe that one was a little more rapid moving, but anyways, I've read about comparisons between the two. The interesting thing is that SARS one came as a bear market was bottoming, and now you've got this disease out of China as at least the North American markets could be topping. So it's interesting. The shutting down the exchange is the wrong thing to do. It makes anything worse, but in the bureaucratic mind, they can't have anything bad happening, and particularly bad is when you've got plunging prices. And so last night I looked up, and there was a time when the U.S. closed the New York Stock Exchange, and that was in August of 1914, with the start of hostilities in Europe. And there was a huge demand for cash and liquidity, so the U.S. was losing gold to Europe, and various grain trades were shutting down. So the exchange people, in a panic, shut down the exchange for quite a few months, and then they woke up and realized that, hey, there was a lot of money to be made by selling products to England and Europe. But it's an entirely different deal. No, the shutting down of the financial markets should never be done. Prices traders should have the right to transact and clear business, and it's a bad thing to do. And it's a sign that the bureaucrats are panicking. And of course, there's grave concerns if you were anywhere near, and who knows where the virus is now. But yeah, I feel sorry for the people who are threatened by it, but I think it'll eventually resolve itself, and the sooner China gets back to trading, because the trade will happen elsewhere anyways, so you might as well have it happening in their normal markets. So it's like in the case when the U.S. stopped trading in 1914 at the main exchange, there was all kinds of little curb exchanges. They even called one a gutter exchange opened up. So people will transact business, and it is best that the authorities do not deny the ability to transact business.
Bob, can you recall the great Spanish flu epidemic of 1919 that eventually killed about 60 million people worldwide? Did they close down the stock exchanges then?
Not in 1919, no. It was just an unusual event in August of 1914, and part of the reason in that is that the powerhouse in Wall Street, J.P. Morgan, had just recently passed away, and it's quite likely some historians feel that if Morgan had been there, common sense would have prevailed. But they didn't do it in 1919. So, their exchanges should not be shut down.
And Bob, nowadays, do you have to have the trading pits where people are cheek by jowl? Can't you perhaps just trade from home and do your job?
No, yeah, you've got big systems set up so that institutions can transact trades between themselves. So, no, there's all kinds of ways these days of getting around it. So shutting down the exchanges in China is just plain foolishness.
We'll have more with Bob Hoye, and we'll include some listener questions like we would on the regular version of Bob's weekly show. Right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Bob Hoye. Bob, first of all, we'll get to the listener questions that we get every week. People can send them to info@housestreet.com. We have a question from Kate. Bob, what about silver? Analysts say silver is about to go parabolic at any moment. I don't want to miss the silver express train leaving the station, but looking at the reports for gold and silver, it seems like long speculator positions are at extremes. Do the weak hands need to be shaken out somewhat before the next move up for gold and silver?
Well, silver and silver analysts, oh dear. I've been in the market since the mid-1960s, and I'm sure that every year since then, some silver analyst has pointed out that there's a shortage of supply, and it's going to go to the moon. And there are times when it does go to the moon, and we had a terrific rally last summer, and became overbought. But silver, in a time of financial risk, we've been in a terrific bull market, financial bubble, and at times you've had some rallies in gold and silver, and that was the latest one, popped up last year and became overbought. But now I've seen it here. Got one headline here this morning. Silver is the number one conviction trade for 2020, and it's going to go up exponentially. And the reasoning is that whoever's come out with this research is looking at the gold-silver ratio, which is up to 87 or something like that. And this goes way back in 1980 when the big promotion for silver and gold concluded. Promoters on the silver side were convinced that it should trade at a ratio of 16-1, because historically it had done that for a long time. But our research since has shown that when you're in a boom, the gold-silver ratio goes down. And then when you're in a financial contraction, the gold-silver ratio goes up. And then on each of the big financial contractions since the 1840s, the gold-silver ratio has gone to new highs. And even, the last really big high was in 1990, when you had the end of the commodity boom and into the 90s, when Chase Manhattan and Citigroup were almost going broke, and Greenspan was the chair of the Fed, and they had to put in special amounts of money, and the gold-silver ratio in that crisis went up to 100, and then it came all the way down with subsequent booms. So here it is now, and this week it broke above the high of a couple of months ago, and I think it's heading up. And the reason why it's heading up, the gold-silver ratio, is because the gold-silver ratio is kind of like a credit spread. So in a boom, it narrows, gets a smaller number, and then in a bust, it gets a bigger number. So the analyst that is using, his opinion is that the gold-silver ratio is out of line, is just dead wrong. The gold-silver ratio is doing what it should be doing, going into a possible financial contraction. And actually, even the volatility, the swings in it since August have been terrific. And now it's more quietly heading up. So, there's no reason to be a strong buyer of silver or silver stocks now. Most people should own some gold as kind of like an insurance. And we really like in the sector, the gold stocks, when you're going to have if we do go into a financial contraction, it sets up a long trend in rising real price for gold, and that in turn sets up a bull market for the stocks, because as the real price goes up, it reflects on improving operating margins for those miners. And then also as the real price goes up, it helps the evaluation indirectly of exploration properties. So we are heading for a terrific bull market for the sector, but there could be some stumbles over the next little while.
Bob, another question. This one comes from Cecil. Bob, I know you're bullish on gold stocks over the next 5 years. Are you, Bob?
Yeah.
Okay. But Bob has been predicting a significant market sell-off, which he again points out would lead to a sell-off in gold stocks too. Is it time to start buying the gold ETFs, or should investors be waiting for declines that might come with a broad market sell-off?
He's got it right. Indeed, in the last couple of months, the stock rallies have been outstanding. Now, this goes back to early October when my colleague and we thought, hey, this is going to be another rally in here. And if it's strong enough, it could conclude in the classic December-January period. And then outlined previous examples where terrific speculations concluded in this window. One, of course, was the mad speculation in gold and silver that peaked in January of 1980. I think it was January 20th. And then you also had a terrific bull market for stocks in New York, peak on, again, January 11th of 1973. And it was followed by the worst bear market since the 1930s. And then another big party was the Tokyo market with the Nikkei index soaring right up until the last trading day of 1989. Even then, also a couple of years ago, we played the seasonal on this one with, in early October of 2017, the advice was that, hey, everything's going to get bubbled, but it could conclude in that December, January, and that was also the high in December for the Bitcoin mania. And then in the middle of January, it was the high for the broad stock market, from which some senior indexes sold off 20%. So a strong market into this time of year. So then you want to determine how strong is it. Well, this is where our technical work came in. We had upside exhaustions. We had the sequential sells, and also we had various valuation indicators that were exceptionally high. And what we were writing in the middle of December was that we've got all these excesses. And you know that once you have the first breakdown, like taking out a previous low, that the top would be in. And then the interesting part was the transition in between, which we were then keeping track of credit spreads and the yield curve, as well as industrial commodity prices, and noted that as each of these break down, that would be saying that an important top is in. So this started, some of these failures were a week before the story about the virus in China threats. Now that made the sell-offs a little stronger than they would have been otherwise. And now you've got, copper's had a tremendous fall, as even some of the other base metals have been weaker than copper. And you've had crude oil sell off quite dramatically as well. And maybe one should be looking at, as I did our study yesterday, some of these are approaching a level where they could find support. So I think the rush and the fear of a threatening disease is in the market, and then now what we want to do is just see how the different aspects of the market, which would be reliable credit spreads and the yield curve and industrial commodity prices. And it looks, Jim, as if an important top has been accomplished, and we have had definitely the loss of momentum, and we've also had an important breakdown in prices. Now, the speed at which industrial commodity prices fell suggests that there could be some important traders on the wrong side of this trade. So one would want to look for, maybe some reports of insolvencies or maybe even default problems. And this is just being realistic. When you get fast moves like that, sometimes there are important people on the wrong side.
Now, Bob, among the headlines that you dug up for us, the Richmond Fed says the manufacturing index has seen its best level since 2018. What's behind that?
Well, there's a built-in business being done, which could be still the Trump reformation going on, whereby businesses are being allowed to keep more of the money they make and making it a more attractive to do business in the United States. So money has been being repatriated. So maybe there's still some positives there. But then they came in with the GDP figure at just a little over 2%, where some were thinking that maybe 3% was possible. But a GDP number is always old history when it comes out. So, but there's still, there was other headlines as well. There was one about refinancing boom fuels mortgages to a post-crisis record. And that's an interesting one. And on the refinancing boom in mortgages, getting up to the levels that were not seen since the last big boom. That's something that one should focus on. So underneath, you've got some pretty good economic series going on that's positive. You've now had the financial markets turn negative, and when you've been in this era of inflation in financial assets, the financial markets are such a big proportion of the overall economy that when the financial markets turn down at the end of a bubble, business activity, or what they call it, the economy, could turn down fairly soon with that. That was the case in 2007, where the market peaked in the middle of October and the recession started that December, whereas in the pre-bubble world, the stock market would peak 10 to 12 months before the economy did. And this is why economists, in making up a set of leading indicators on the economy, put the stock market in, put the S&P into a leading indicator index. And when you get into a world of financial manias, there's no lead. It can be pretty close. Like, for example, in 1929, the New York market peaked in September, and the economy peaked in that August. And then the previous great financial bubble was in 1873, when the New York market peaked in September. And then according to that was the National Bureau of Economic Research, they determined that that recession started in October. So you've had two great bubbles. The example where the stock market peaked in September and the recession started within a month of that. So this is what here. So now, if the financial markets have really rolled over and are heading south, one would expect the economy to turn down with it, and it could be being confirmed now by the weak industrial commodity prices. And then the other one that has really headed south fast was the dry shipping rate. The Baltic Freight Index is turned down and tanked as fast as it did in 2007. Sorry, that was 2008 when it did it. So, Jim, there's a number of things that have been saying excessive, and there's some things now say that things are heading down.
The world's pile of negative debt has surged past its highest since 2016. What does this mean things like pension funds, insurance pools, and people who are trying to save for their retirement.
Jim, this is one of the greatest tragedies in financial history. It is all due to these theories of economic intrusion where some guys at the central bank think that the economy should be stronger. You can't determine that. That's just straight arbitrary. So then they have this theory that if they inject credit into the markets, it will boost the economy. But that, in formal logic, is called a primitive syllogism, where you see two things happen at the same time, then you assume that one causes the other. And the classic on that one is that certainly the sun rises in the morning, and that's when the roosters crow. Therefore, the rooster crowing causes the sun to come up, which we all know is nonsense. And this is an important key in central bank intervention. On any business expansion, credit expands. It's the way it works, but one does not cause the other. So what has been happening, these guys have been pushing, the central bankers have been pushing credit into the markets. And then the next part of this story, Jim, is that the public chooses what will be speculated in. So back in the 1970s, the public was choosing to speculate in commodities and tangible assets in general, and then that helps drive the economy. So it looked like the theories of injecting credit drove business. But then when you get into a decade where the public decides that they're going to speculate in financial assets, and then particularly during the Obama administration when the economy really was slow, then the central bank was being easier than it might have been, thinking that their credit is going to drive business. When the public wants to speculate in financial assets, that's where the action will go. So this is where you've had the absurdity of, in Europe, bonds being bid down to not just zero interest rates, but negative. And it's not a policy whereby an academic or a central banker said, we're going to put interest rates to negative because we think it'll be very good. It's a byproduct of this idea of pushing the economy by injecting credit. And when you're in a period of time when the public chooses to speculate in financial assets, that's where the extra credit will go. So now, here you have on the pension fund and on insurance funds, you have actuaries there who calculate how much the fund is going to have to pay out so many years hence, and they have to try and get a match on the income that the fund is making relative to the outgo. And when you're down to zero on bonds, it's impossible. It is absolutely, absurdly impossible. And it's forcing then fund managers who would only be buying the highest quality bonds to buy the lowest quality stuff at huge risk. So when this one's over, I think there's going to be textbooks written on just how mad policymakers have been, based upon which at some time people will decide that their theories have been not just in error, but because they have been pursued so aggressively that their theories are absurd, absolute nonsense, a fraud, a farce, whatever you want to call it. So, Jim, we live in very interesting times for those of us who like to watch the markets, and there's been nothing like, there's never ever been a minus interest rates. It's never happened before. And it is such a distortion, and the markets eventually push back artificial distortions. So the next bear market in bonds is going to be very interesting. So,
well, Bob, you're a market historian, and I know you look back at what the ancient Romans did, the Chinese, the Egyptians.
Mm-hmm.
They were very smart and clever people. Did they ever have negative interest rates?
No, there wouldn't have been negative interest rates, but one of the good writers back 2,000 years ago, Cicero, he did observe that when you had a financial or a credit crisis in the markets in the eastern part of the Mediterranean, it would eventually come in and hit Rome, the financial capital. Now, this reminds me of a story that years ago I was at the library and I was trying to find what interest rates were in ancient Rome. And then I came across a book of illustrations of the graffiti on the walls of Pompeii as, Pompeii was being excavated. And I didn't find anything about interest rates, but I did see a scurrilous graffiti that said, Julia does it for 2 drachmas.
Well, of course, with inflation, it'd be 2,000 by now.
Well, we don't know how much 2 drachmas was at that time. But anyways, I love that bit of graffiti. Julia does it for 2 drachmas.
Well, good for Julia. And did Caesar charge any tax on that?
They taxed where they could, and when taxes weren't enough or people squawked, they then went to currency depreciation. And so they were doing the same thing in Roman times as policymakers have been doing for the last 100 years.
And
Same old.
And how did currency depreciation work out for them?
Rampant price inflation, great social distress, so that Diocletian, he was an emperor of tremendous organizational abilities, and he then put on price and wage controls. And if you offended these price and wage controls, you got the chop. So then in 1974, whenever Canada and the U.S. tried price and wage controls, I was most interested to see in Canada if the Liberal government would put in the death penalty for making economic offenses, but they never did. But price and wage controls never worked, so they were quickly abandoned, thank goodness. But, there was a book I found published in 1938 by a very accomplished journalist who then had interviewed all kinds of ancient scholars. And the title of the book tells you everything you need to know, and it was The New Deal in Old Rome. And, of course, in the 1930s is when Roosevelt was imposing what he called the New Deal. And then this book, in a scholarly fashion, points out that what Roosevelt was doing as a New Deal, Rome had done 1,700 years earlier. So when it comes to policy making and financial markets, there really is never anything new.
We should remind our listeners, if you have any questions for Bob Hoye, you can send them to info@howestreet.com. Bob, thank you so much for being on the show.
It's a pleasure, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Coming up, Robert Campbell, next on This Week in Money.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Robert Campbell. He's the author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money, Bob.
Thank you very much.
Bob,
Always look forward to this, as you know.
Oh, yes, we have the best chat off air.
One of these days, you and I are just going to have to talk, and they'll learn more about you and I than this formal conversation between us.
And it mostly will be about airplanes.
95%.
Bob, you have an upcoming seminar. Where is it, and what will it be all about?
Hey, that I have anywhere, usually 2 to 3 seminars a year, and this next one is July 25th of 2020, and the topic of it is wealth and health. I've been talking physical fitness for more years than I've been talking about real estate cycles. And finally, and all my followers know how addicted I am to staying fit and healthy. And I'm going to finally start talking to people more about it, about what I've done over the last 50 years and why I'm the healthiest and most fit and youngest looking 72-year-old man in Southern California. I'm going to give away my secrets, Jim.
We'll talk a little bit about that towards the end of the show.
Good.
How are the real estate markets looking in the U.S.?
Well, the national markets are doing better than the California real estate market, but it's still in a mild uptrend. Some cities are doing fairly well, but the growth is significantly down from what it's been the last 2, 3, or 4 years. I think back in 2015 it was up at 13.5. Now it's down to 3.5, but prices are still going up. Some cities are still doing well, those being Tampa, Florida is the strongest city. Miami's still strong. Phoenix is still strong. Las Vegas is still strong. And a few of the weakest markets, and based on not only on my analysis and other analysis, are the California market, specifically San Francisco, and Seattle's weak too. And Portland looks like it's ready to roll over. So we have somewhat of a bifurcated market that the California markets are barely hanging in there, where the rest of the country is doing reasonably well, and that the risk of a downturn anytime in the near future is still relatively low.
What are the charts showing for real estate?
Exactly what I explained. Just right there, Jim. That the fact that I use 5 indicators that I present in my book, Timing the Real Estate Market, to give me signals, because it's so accurate, and I turn them into a model. But that from existing home sales is like hugging the zero line, zero upward movement, but zero growth, maybe a little upward. Building permits are picking up a little lately. They really took a dip. Now they're starting to come back a little. Mortgage defaults are still falling, even though at a smaller rate than they were in the past. And interest rates, of course, are 1 full percentage point where they were a year ago. So that, based on those key indicators right there, the housing market is still holding its own.
Are the chart formations for real estate similar to the chart formations for stock markets?
Exactly, absolutely. In many ways, I've been investing in the stock market for 50 years, and that's how I learned how to create a timing model for real estate, in fact, because I learned a long time ago, Jim, that markets are markets. Whether you're trading stocks or trading real estate or trading gold futures, a market is a market. It's all driven by supply and demand, and there's certain key indicators that you can follow to determine, whether demand relative to supply is increasing or decreasing, and that, of course, determines what side of the trend you should be on.
Being specific, what's the latest on California real estate?
San Francisco is in trouble. San Francisco remains the weakest market, along with Santa Clara, and prices are incredibly high. The other cities, as far as California goes, Los Angeles is the strongest market of all, but the Bay Area market, San Francisco Bay Area markets are the weakest, and you could, my timing model gave a sell signal on San Francisco in September 2018. And since that time, there's been, prices may be up over a year basis, relative back to, a year and a half ago, prices are still about 1% below their peak. So, in other words, you haven't made anything. So, in my view, the risk of lower prices ahead far outweighs the potential for higher prices. So I would stay away. I would stay away from most markets in California, Jim. It's just because there's too much risk relative to the potential rewards. And if you look at the things that I look at, like I look at, historic indicators like the length of up cycles, the length of down cycles here in California, and other indicators, and the weight of the evidence is this is a high risk market, and the chance of a downturn far outweighs any potential for future profit. In other words, right now you're running in front of a bulldozer picking up $10 bills.
Can people lose all their money in real estate?
Yes, they can. And people don't understand. And the reason I can say that, to all the readers out there is, guys, I'm almost 73 years old. I was born on a building site here in San Diego. My dad was a builder developer for 55 years, so I know the business, and I can tell you, real estate is very cyclical, especially so in California, which is where I operate out of, which is wonderful for market timers. It allows you to buy low and sell high with big price moves in between. But it is very, very risky, and I mean these cycles, and you can lose all your money in real estate in a dozen different ways, and they'd all surprise you. I mean, you can be a remodeler. I have a remodel friend of mine. He remodels home. He did like a $2 million remodel, fix and flip in L.A. and got sued, and the lawsuit cost him $500,000. I mean, that's just you don't know what's going to happen in the future, what can happen, and that's why I'm not a buy and hold investor. I'm a buy low, sell high investor, and some things I hold for the long term, but otherwise is what you do. You continually adjust to a changing tomorrow, ever changing tomorrow, and just hopes that if something does bad happen to you, you've got the resources to avoid going broke. That's my secret of success.
U.S. stock markets keep hitting new highs. Do you think this momentum can continue?
Yeah, I do. I think it's going to keep continuing. As you know, we've talked a lot of times. I keep saying it's going higher. It's going higher. The money's and it's still capital flight, Jim. Money's coming in from Europe, from China. We're the best looking horse in the glue factory. So here it comes. So that that should continue. That's still a relatively safe place for your money. U.S. stock market.
China has closed its stock market at least until Monday, February 3rd. Could this move have more to do with economic problems in China than the coronavirus?
I guess if it gets real bad, if they have to keep these things closed, but then it depends. If this thing gets out of control in a significant way, businesses will definitely be affected. So it's going to have some effect. But, how bad is it going to get? Is this thing going to get out of control where it's the whole world's at risk, to some degree, of losing, millions of people? Of course that would affect the markets, but we really don't know that yet. I'm not qualified to make an opinion on it. This is in God's hands at this time.
Would you get a shot against coronavirus if there was one?
No, I wouldn't. Only because I'm so healthy. I would probably get it instead of avoid it. I've had doctors tell me before, if you're really in good shape and they see how I work out, I run, I'm thin and strong and all that, and they go, Bob, never get, if it's anything comparable to a flu shot. I haven't had a flu shot in 20 years because I've had medical doctors say that you don't need a flu shot because your immune system is already like jacked up super high. The only thing a flu shot's going to do for you is possibly give you the flu. But they know how the, weak bodies are the ones most likely to get it. They said, you won't get it. You're just too strong. So I don't get that. But I guess if this thing turned into a super panic, of course, and there was a shot you could take where it greatly reduced the chances of you getting it. Yeah, now that I think about it, I'd get that shot. Wouldn't you get it? And I don't want to die from the coronavirus, that's for sure.
We'll have more with Robert Campbell right after the break.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Robert Campbell. Bob, why is gold going up?
Gold is going up, and it's all about time cycles and the relationship of one asset class to the other. Gold is essentially, and I've been investing in gold on and off, since 1979. Back in those days, I sold everything that I got back, back on the where I liked it as an investment, some time ago. But gold is going up. Gold is, it's not an inflation hedge. If you chart gold against inflation, you see it's a lousy and inconsistent inflation hedge. During the short term. In the long run, yeah, it holds its own. But like over 5 or 10 year periods of time, does it correlate well with the rate of inflation? No, not at all. Sometimes it's exactly the opposite. But I think gold is a fear thing. And what I think is going to happen to gold is this. It's definitely in an uptrend right now. And I think gold, what's going to happen is gold is going to be one of the tools that saves the world, Jim, from financial collapse with all this fiat crap money they're printing and these zero-rate interest bonds that they're selling to people. I mean, that have a guaranteed loss built into them. I don't think that they can afford to let those guys go because that's much more wealth in those than there is in the stock market. If they let that go, all the rich people wouldn't be rich anymore. The whole economy would take a dump like you wouldn't believe it, and it would hurt everybody. I think that if they can save the system, it'll be a net positive for everybody considered. And I think they'll end up backing the dollar with some kind of gold guarantee, whether it's 20%, 30%, 40%, I don't know. I'm kind of in the Jim Rickards camp. If you know that, why invest in gold, I like his thinking. He thinks that they could back it up with, depending on how much money is actually out there, 20 or 30%, and that would restore confidence so you wouldn't have a currency panic where everybody panics out of the dollar because there's too many of them. We get hyperinflation, then everything goes to hell. Then we have Venezuela on our hands. I don't think they'll let it get to that.
Is gold still the antidote for debt and fiat currencies?
I think it is. I think it's an effective. It may do the job. I know the government guys don't like it because it puts a clamp on their free spending. You want a deficit spend and the Fed create all this money. Guess what? The price of gold is going to go up relative to the U.S. dollar. So do what you want. I mean, does that help you or hurt you? You figure it out. At least it's backed by something where it's a total confidence thing, Jim. All confidence. There's no way you can measure it with supply and demand. When people get scared to death, you know what? They flee to gold. It's a very thin market, and there's no fever like gold fever. You could see this stuff jump to $5,000 an ounce or more in a short period of time because that's where the smart money wants to go. They don't trust anything, but they'd rather put their trust in gold than like Japanese yen or euro dollars.
Where are we likely to see interest rates go from here?
I think the big surprise of 2020 is going to be rising interest rates, Jim. I think we're on a course right now, and I can't prove this conclusively, of course, with a lot of evidence, but knowing cycles the way I know cycles, and I'm a real cycle man. I know, one of the three principles in economics that has any value, according to me, is that everything returns to normal. Everything eventually returns to normal. And interest rates are eventually going to turn to normal. And the rates we have right now are not normal. They're at 50-year lows. That will change, Jim. And those rising rates all hell is probably going to break out when that happens.
Could we see easy credit alongside rising interest rates?
Boy, you really want to have some fun, huh?
Why not?
You know what? When you see interest rates rising like that, and even though it gets easy to get credit, the rates for that, people are going to get scared when they see that, Jim, because not everybody's into the easy money, easy interest rate kind of a thing. Not everybody's that stupid, especially after the experience that we just had 10 years ago. I mean, you'll get some, but it won't be to the same degree that it was back then.
Could the ongoing bond bubble be ready to burst?
I think so. I think that's what I said. I think we're going to see rising interest rates. I think they're going to return back to normal. And one of the reasons I think it's going to return back to normal is because I think we need rising interest rates to help save the pension business, which I understand represents about $17 trillion. All those guys are going broke because they can't get a return on their dollar, and they're paying out at a rate that assumes a 7% rate of return. Jim, they're not getting 7%.
Well, right now, we're also facing giant increases in our insurance rates. Again, because I think the insurance companies aren't making any interest on their deposits.
What kind of insurance companies are you talking about?
Well, I'm talking about my condominium, for example. Condo owners are getting hammered.
Jim, like here in the United States, they say that inflation is 2%. Insurance rates have gone up for everything way more than 2% a year for the last 10 years. Everything. I mean, there's another racket. Car insurance, everything's gone up way, way more than 2%. So these guys all have a problem. But the pension problem is the biggest. And where it's the worst is in the city of Chicago. To pay for the retired cops and firemen, their pension fund is only funded by something like 30% and 70% underfunded. They've raised property taxes in Chicago by 50% over the course of the last 5 years, and it barely makes a dent in the shortfall. You know what's going to? You know what? If I have to make a prediction, I could make a case for Chicago going the same route as Detroit. How about that? The corruption's the same. Very, very high socialism. Everybody wants something for free. And the freaking government employees that are all making way more than they're worth, and they're not funding the pension systems properly, and the payouts are guaranteed. I could see, the city of Detroit had lost 60% of its population in the last 30 or 40 years. That's a big decrease. What would that do? What would that do to your real estate portfolio in Detroit if you were one of the unlucky ones that live there? You'd be totally screwed. That's just one of the risks. That's just one of the main risks. Most people don't think about that. I mean, would I make a long-term investment in Chicago? Not in a million years.
Frank Dodd was put in place to end bank bailouts. Has this opened the door to bail-ins? That is, they dip into your bank account to look after any banking problems.
I'm not familiar with that provision. The one provision I am familiar with is when Frank Dodd eliminated bank bailouts, about 2 or 3 or 4 years later, there was some attachment to a bill that struck that provision from Dodd-Frank. In other words, banks can be bailed out now, Jim. Gee, wonder why they did that.
Do people seem to be complacent right now with the stock markets and the real estate markets?
I would say generally so, yeah. Complacent? They're optimistic. The real estate sentiment here in the United States just hit a new 10-year high a couple of months ago at almost 94%. Which means almost 94% of the people think real estate is still a good investment, and it's going to be a good investment in the future. It can only go to 100, Jim. Then what? I mean, the cycles of things. And what's interesting, so it's at almost 94% right now, or it was a couple of months ago. This is according to Fannie Mae. At the bottom of the market in 2010, 2011, 2012, you know what the reading was? 60%. The bottom of the housing market, only 60% of all Americans thought real estate was a good investment at those low prices. Today, at these high prices, 95% think it's still a good market. Humans are 100% wrong at nobody buys low and sells high. Everybody does just the opposite. The smart people buy low and sell high. So you got to follow stuff like that. But with sentiment being that high, how high can it go? It can go 100. That's maxed out. Everybody in the United States thinks real estate's going higher. You know what? When everybody's on one side of the boat, you know what the boat does? It tips over.
What would Warren Buffett do?
I'll tell you, what would Warren Buffett do? What Warren Buffett is doing. Warren Buffett, Berkshire Hathaway, at the bottom of the stock market back in 2009, his company had approximately $25 billion in cash or cash equivalents. That number today is at $128 billion, a record high. So let's not try to figure out what Warren would do. Let's just watch what he is doing. He's accumulating cash, Jim. He's long term. He thinks that And I like his way of thinking. You know, like, same way I feel about real estate. You got to measure risk, today's risk, relative to potential future return. He thinks there's better deals coming down the road, obviously. Or he wouldn't have $128 billion making no money in the bank.
If you had $1 million to invest today, what would you invest in?
Commodities and gold. That's going to be the alternative investment. That's what's going to do well the next upcycle. That's going to be the top performing asset class. Commodities, they're very depressed, including gold. I mean, some commodities are more depressed than gold, but gold is near the bottom of the cycle, and gold's starting to break out right now. Other commodities are too. Commodities typically, from a cyclical and historical standpoint, that commodities perform best when the stock market is going nowhere or declining. In other words, so relative to the stock market, they're a counter-cyclical asset class.
Was it a mistake for Canada and the UK to sell off all their gold at bargain prices? And is it wise for China and Russia to buy all the gold that they can lay their hands on?
That's one of the reasons I think. I don't think China and Russia are stupid. And I think the reason Canada and England got rid of their gold, I'm pretty sure, a lot of it was for political reasons. You know, that we'll show you that we're not going to, we think the gold standard's barbaric. We'll just sell all our gold. So we don't even have any anymore. I think both those countries regret doing that right now. If you could ask them, would you have made that, knowing what you know right now, are you glad you made that deal? I think anybody with a brain would say, no, we made a mistake.
Would you consider buying an electric vehicle?
Probably not. I don't know. You just can't go very far in them. You know, I don't even, so I'm not into electric cars. I'm more into, if I was going to buy a car, I'd like to buy like an old, 1968 Camaro with a 396 engine in it that rips and snorts. But you can't drive cars fast anymore. So I'm just not into cars. I don't, in fact, I like the old cars better than the new cars.
Do you have any health tips for us?
Oh yeah. Health should be your number one investment, gang. Number one investment by far. Money's important, but health is more important. And the three things I tell people, and I'm going to be teaching people at my seminar on July 25th, the most important thing to do, and I'm speaking to men primarily, because I don't know about women. Women have big hormone changes at 50 that guys don't have. And I'm not a woman, so I can only speak for us guys. But, you got to keep your weight down. You got to stay strong. You got to stay fit. You got to take care of your legs. And 80% of your weight, of keeping your weight down is diet, 80 to 90%, and staying fit and strong and healthy. That's where exercise comes in. So you need to do both. But I'll tell you, Jim, and all you guys out there, being healthy and fit, and I spend 2 hours a day working out. I'm 72 years old. I have to. I'm 72 years old. But I know that I look really good. I feel really good. It gives me a lot of energy. And, some people are hooked on drugs and alcohol. I'm hooked on working out. There's a feeling that comes from working out. Right after this seminar, I'm going to go, this speech, I'm going to go run up hills. And that's the most exhausting thing I do, but that will keep you in good shape. And I'm telling you guys, when it comes to health and fitness, it makes you feel really good about yourself. It gives you confidence. There's nothing bad about working out. And it's whatever cost you have to put in to stay in shape and all that, you get 10 times the amount of benefit back. It's that important. And so and you all know that, and I've known doctors over the years, and they've told me, they said, medical doctors said, I have some very wealthy patients, Bob. I've seen you working out for the last 30 years, running on the beach, lifting weights and stuff like that. I said, most of my patients are very wealthy. They would trade all their money to be as in shape and healthy as you are. Isn't that interesting, Jim? And that's something I'll always remember, hearing that from a doctor. Because they see people that get older and get sick, and it is, to a large degree, avoidable. That is avoidable. And so that's kind of the way I look at it. And I'm trying to spread that message, to my followers and anybody that will listen, because the benefits are so great. It just makes you feel better. And it's, would you rather it's like, yeah, as long as you're comfortable financially, you're fine, right? You know, if you got $5 million, you're going to be okay. Is $10 million going to make you twice as happy? No. Would you rather so I mean, you don't even need $5 million, but I'm just saying it's not about having a lot of money. But if you're going to be really, really healthy, you got it made, man. And when I get older, and when I get to be 80 or 85 years old, you know, God willing, you know, some people are going to go out and buy expensive watches and expensive houses and do expensive things, buy cars and things like that to show the world how successful they are. I'm going to spend all my money on health. I'm going to start taking anything that won't kill me, that'll keep me younger and healthier and stronger and happier. If it's human growth hormone, I've studied that. I'll start spending my money on that. I mean, that's not cheap. That's $2,000 a month right now. Most people can't afford $2,000 a month for a couple injections. But the benefits are so big, and I'm convinced it doesn't hurt you, so that's how I'm going to spend my money. And I want to go out like Kobe Bryant, like a shooting star, Jim. You go, I just saw the guy the other day. He was great. He was full of energy and all of that, and now he's gone. That's the way I want to go. But that's what the health is. You know, that being smart about real estate, that's really, really important. And the biggest message to all you people out there, I don't care whether you invest in stocks or real estate or whatever, the real secret of success, of being a successful investor, is buying an asset when the price is depressed, buying low. Now you have a lot of options going forward. When you buy high going forward, from that point going forward, that's when the trouble starts. I mean, you can go broke, you can be over leveraged, you can lose all your money, you can lose your job, you know, the bank forecloses on your place. I mean, everything can go to hell. But if you can buy when things are cheap, you got a head start over 95% of all the people. So knowing how to buy low is really, really important. Buy low and be healthy. And you should have a healthy life. Love what you do, enjoy your work, be good at it, make an above average income, and have a woman that you love dearly in your life. You get those 4 things, you're the happiest person in the world. You don't even have to make $10 million a year. Even if you made $100,000 a year, you're the happiest guy in the world. But you got to be fit and healthy.
How can people find out more about your seminar, your newsletter, and your book?
Okay, they can go to the following website, and it's real easy, realestatetiming.com. Just like it sounds, no dots, no dashes, realestatetiming, Timing.com, and you can learn all about me. You can buy my book. My book tells you exactly how my timing model that I have created, and over the course of the last 38, 40 years, it has a success rate of correctly identifying the direction of the market of somewhere between 80 and 90%, which is excellent. So I know that. I never second guess my timing model because most things in life, Jim, don't give you those kind of odds. And so they can find out about me if that's what they're interested in. And if you're interested in becoming healthier and happier and younger looking, come to my seminar. It'll be worth it. I guarantee. I mean, if that's your interest, if that's your big interest, fly from Canada or wherever you're hearing this broadcast from, fly to Southern California, and I guarantee you will get great value of what I have to tell you about health and fitness, along with real estate cycles.
Bob, thanks a lot for being on This Week in Money.
I enjoyed it, Jim. Thank you very much. You take care, okay?
I will. My guest has been Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye and Robert Campbell, and thank you for your questions. If you have any questions for us, you can send them to info@howestreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh, Cypress Development's Don Mosher, and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Ray, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, pleasure to be here.
Larry, we're a day earlier than we usually chat, as we do every week, but you do have a news release that will be coming out later on. What's in it?
Okay, Jim, seeing as this will not be published, the interview will not be published until Friday evening. I'll talk a bit about that. Just before I get there, I just want to remind everybody that we're going to the fully charged convention in Austin, Texas. We'll be there all weekend, coming back on Sunday night. But what I'd like to point out is that it's oversold. You can't get a ticket to it. And so we're really excited about this because we're going to be in a venue that really recycling, electric vehicle recycling, just fits in like a glove. And so I'm happy to be attending that one. I think, we'll get some good following out of that. And the press release, I'm going to be talking about a couple of things that have happened recently that are going to, again, put recycling front and center. And I'm talking about recycling lithium-ion batteries. And that couldn't be more exciting and germane to what we're doing. And the first thing is that the European Union has approved a 3.2 billion euro, 3.5 billion US in subsidies for 7 member countries. And those are Belgium, Finland, France, Germany, Italy, Poland, and Sweden. Now, that's a lot of money. And I'm looking forward to the day when the North American governments decide that maybe a alternative supply for precious metals that go into the recycling of batteries or into the EV batteries, that maybe recycling's got a role in it. Maybe they should be paying more attention to that. And more funding should be available to recycling companies for research and development, way beyond what is being spent now. When you look at the spending that's going on and for manufacturing batteries, it's in the tens of billions. And I don't think the recycling area may have reached $100 million in the last few years. So that's like, developing a battery, but not looking at the end of the game when you have to dispose of that battery. And you have to do it in an environmentally friendly way. So that's what we've been striving for. We've got our patents, and most other companies out there really just have proprietary solutions, which we can't even compare the results of those solutions to our results. So everybody asks me, what about this company? What about that company? Sorry, can't say much about them because there's nothing in print out there. They don't have a patent filed that we can read, like ours are filed. And actually ours are basically, the patent is there for everybody to see. So there's no secret on that. But this is just one of the things that I can see. Hopefully the governments decide that maybe saving the environment should be at the top of their list instead of just all about other aspects of the global warming, and realize that this is a very important area that has to be addressed. Now, the second thing, China's Ministry of Industry and Information Technology has just recently published new regulations to be effective January the 1st, that these batteries have to be recycled with a 98% recovery of nickel, cobalt, manganese, and an 85% recovery of lithium. We do know that mostly these batteries end up in smelters or dumps, and they're only getting probably about 60% of the cobalt in optimum conditions, and very little of the nickel or manganese. It all ends up in slag, and certainly none of the lithium, which is treated differently. And so again, that puts us in the front and center. That's something we've been working hard to develop and maintain. And I think this year is going to be the big payoff for all the hard work that's gone into it and the faith of the investors in this project, even though they are not seeing the kind of values that we'd hoped we'd see. But that is coming around the corner. To optimize that, I think we're coming into very strong markets. And strong markets help, good products, good earnings, those types of things. So we just need that to support us. And just to mention, we are got initial results from the recycling of the DOE batteries, and when those initial results are approved and supplied to us by Cametco, we'll be announcing those. We're moving ahead on trying to get Canadian help in big grants, in the form of grants for our recycling process, as we have in the U.S., where we're supported in the collaboration for recycling lithium-ion batteries with the DOE and their labs like Critical Materials Institute. So that's my greatest thing is, let's get down to that show on the weekend. I liked the resource show where there were good crowds. Now we see it's oversold, and on a show that's more germane to what we do, and I expect that we'll have a lot of interest at the booth.
Larry, for people new to American Manganese, what are you guys all about?
American Manganese is a critical metals company who has a good portfolio of patents, and cutting-edge patents. We have a patent for our manganese, which is really actually for manganese recoveries of very low-grade deposits. We have 2 patents for recycling lithium-ion batteries. The manganese patent was the cornerstone of that one. We are looking forward to an excellent year this year.
How can people get more information about American Manganese? How can they contact you, and where are you traded?
They can contact me by emailing me at LREAUGH@AMYNN.com. They can phone at 778-574-4444. And definitely go to the website, AmericanManganeseInc.com, and get an education on what we're doing.
Larry, thank you so much for the update, and have fun in Austin.
Well, it'll be fun just working the booth and listen to Zarko wow them.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 30th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
My guest is Don Mosher, corporate consultant for Cypress Development. Welcome back to the show, Don.
My pleasure.
Don, lithium stocks took a pounding over the past week, somehow connected to the coronavirus outbreak. kind of a phenomena around the planet. It wasn't just in China. What can you tell us about that?
I think it's impacted all the commodities. Copper's off quite a bit. Really, a slowdown in China would have a detrimental impact on the actual demand for all metals out there. We'll have to wait and see what it's like. But regardless of that, I mean, you need to look at the bigger picture. I think the coronavirus will probably be relatively short-lived, like SARS. And a buddy of mine, Rick Mills, who writes a newsletter ahead of the herd.com, wrote a really good piece this week on energy metals and EV predictions showing how the strained metal supply. Out of the article, I really am going to focus on the lithium side of it. You know, he's talking about currently less than 1% of the world's vehicles are electric, but by 2030 they're expected to represent 11% of new vehicle sales. The demand that's going to put on all these energy metals is going to be astronomical. Like the Tesla S is a 70 kilowatt battery. It uses about 63 kilograms of lithium carbonate equivalent per vehicle. And the Volt is a little smaller, but comparable. So when you start to actually do the math on where we're at right now and what the demand is and what the production is, we've got a little bit of a surplus out there right now. You know, we're producing about 360,000 tons a year, and we're using about 310 of it. But you don't have to look very far ahead to see where we're going to be going with it. And with the problems that we're having in Chile, Argentina, Bolivia, and he really does take a look at this. Like, there's only been one new player since 2014 that's gotten complete exploration permits in Chile, which is Wealth Minerals. The second largest producer there, SQM's got water problems, so they're not allowed to expand any further, along with Albemarle. And a lot of the spodumene deposits in Australia are pausing operations because with the price drop, they're not making any money on their production. You know, with Cypress, which is really who I work for, we're looking at a new type of production out of claystone deposits in a very stable jurisdiction, being Nevada, in a country that it's got virtually no lithium production at all. So I think if you take a look forward, you really need to be taking a look at where lithium's going to be coming from and where the demand's going to take the prices to.
And so many governments now, too, have mandated that at a certain point they're going to make electric vehicles mandatory and they won't allow the sale of any more gasoline-powered cars.
I think Germany's running along that type of a trend, if you want to call it that right now. I mean, obviously, the government of California always is in the lead of that. So, you know, the anticipated production of seeing electric vehicles, you know, move up to 11% of the market by 2030, I think is very realistic. The issue is going to be where the supply of raw commodities is going to come from. The longer these little periods, like what we're going through with the coronavirus right now, happen, the less money is being invested into finding, developing, and constructing mines in all these varieties of metals. Specifically, my interest is in lithium. But at some point in time, there's going to be shortage crunches. And as you know, every time there's a shortage in commodities, the prices skyrocket.
Don, can you tell us a little bit about Cypress Development, what you do, where it comes from, and what your goals are?
Cypress Development is a lithium development company located in Clayton Valley, Nevada, US of A. We have moved into completing a pre-feasibility study on a claystone deposit in Nevada. We should have that study published here probably by the end of February. Middle to the end of February is the timeline I'm running with right now. And we trade on the TSX Venture Exchange under the symbol CYP. We also trade in the U.S. under the OTC symbol CYDVF. And in Frankfurt, C1Z1 there. All our information is available at cypressdevelopmentcorp.com on our website.
Don, thanks a lot for the update.
Thank you very much.
My guest has been Don Mosher, corporate consultant for Cypress Development. I'm Jim Goddard. Our conversation took place on January 29th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of Howe Street Media Incorporated. Welcome to Company Showcase, an advertising feature on howstreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit. He's the CEO and president of Aben Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Jim, a lot of excitement about gold at both the Investors Forum and the Metals Forum in Vancouver a few weeks ago. Is that good news for your company?
Well, it's good news for the whole industry because gold generally is the first mover, right? And as opposed to the base metals and that sort of thing, the precious metals are moving. Gold's had a tremendous price increase since last May. It's up, $300. Companies, a lot of the majors are starting to move. The big one is Franco-Nevada. If you look at that, it's in the last just over a year, it's moved from about $80 to $146 a share. And that's the big one, and that's the one a lot of people watch, and it's doing it for a reason. People think when gold moves up, royalties benefit. So gold's got a lot of things going for it right now.
And, of course, with the recent things happening in the world, the coronavirus and so on, people like safe havens, and nothing says safe for the last 5,000 years like gold.
No, that's it. Donald Trump's been pretty good for gold. A lot of his erratic behavior, it lends to that whole story. It's uncertainty. When you breed uncertainty, gold is the beneficiary. And and the coronavirus, it's not gonna, it will have an effect on the population that who knows where it's going to go right now, but it could get into the high risk stage. So that'll be good for gold. I'll tell you, the shows the last few weeks it was pretty amazing. I haven't seen it like that in a very, very long time, and I lost my voice. I'm just getting it back now. We were very busy, very busy. There was a lot of interest, a lot of retail interest, a lot of analyst interest, and there was an awful lot of majors there at the roundup.
For people who may not be familiar with Aben, what are you guys all about, and where are you set up?
Well, we're into the gold exploration business. That's our specialty, and our primary project, the flagship, is in the Golden Triangle, northwestern British Columbia. It's called the Forrest Kerr. We've had 4 years there, and been pretty successful. The first 3 years were very successful, hitting some really good high grade. We've sort of defined the high grade zone, and this past year we drilled about 30 holes, and moving away from it, testing geophysical targets, trying to find this feeder that could potentially have in place that high grade zone. And that study, all that work is being completed now. We're just going through it all and planning budgets for next year and how it's all going to come together, what we're going to drill and where. And that's a tremendous amount of data, because over the last 2 years we've drilled 10,000 meters, so 20,000 meters roughly. And that's already telling us some pretty important things. So we're going to continue on this coming year. We have now actually earned our the option for the whole property package now. There's 3 separate claim blocks. So we now have 100% of it, which is good, and that's all in the works. We've got some good plans going forward. Can't tell you exactly how much we're going to spend, and we've got a few other properties we are looking at right now. We've got the Chico in Saskatchewan, and the Yukon is also being assessed because we did some work up there, and we're having a good hard look at that one right now too.
Is Canada known to be one of the most potentially resourceful areas when it comes to gold? Yeah,
it is. There's always a lot of exploration work going on, and you always hope for, that big discovery. Canada's been known for it. There's been lots of area plays around gold. Look at Red Lake. It's got another life cycle going right now with the discovery by Great Bear in that area. Look at Quebec and the that whole the Osisco and everything that's been, that area's had hundreds of thousands, I think, of meters of drilling done. Windfall Lake and all that, it's pretty spectacular. And BC's got the Golden Triangle, which is taking up about 60% of the exploration budgets. All of BC is up there. So yeah, you could say gold is pretty important to the Canadian economy.
For people who may not be familiar with Aben, how long have you been around, and what kind of a success rate have you had?
Aben's been around for, it had the initial uranium cycle, the big cycle we had in uranium, that was our first foray by Aben, was into that. And then when we saw that soft, we had those properties all optioned out. Now, then we moved up into the Yukon in a big way when the Yukon took off and settled into gold exploration, because that's when I got together with Ron Nedlitsky and Tim Termundi on the board and brought in a bunch of other advisors for us to work with in the Golden Triangle. It was, it's been some pretty good times, and that was probably back starting in 2000 and, I'm going to date myself now, 2008, we started looking up in the Yukon and that, and then transitioned into the Golden Triangle, because the Yukon, all of a sudden, it just, the market disappeared on it, and we had 5 properties up there, and now we've got 2. They're still in good shape, promising, but the Golden Triangle is definitely where the interest has been lying, and, it's a third life cycle up there for the Golden Triangle. It's got a lot of new infrastructure, so it's a great place to be.
Where is Aben traded, under what symbols, and how can people get more information about the company?
Well, Aben is traded on the TSX Venture under the symbol ABN, the OTCQB under ABNAF, and in Frankfurt, Germany, under the symbol E2L2. And you can go to the website, abenresources.com. Get all the information you need, and you can get the contact of the office here.
Jim, thanks so much for the update.
You bet. Anytime.
My guest has been Jim Pettit. He's the CEO and president at Aben Resources. I'm Jim Goddard. Our conversation took place on January 30th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.